In this video, I want to walk you through a real case study of a couple with 1.2 million at age 62 wanting to know, should we do Roth conversions? And their plan looks solid, but when we dig into the numbers, we'll see if there's any ways to lower their lifetime tax bill. And at the end, I'll also give you three, well, I'll call them yellow flags to be aware of if you're considering Roth conversions for yourself. So we'll go under the hood, walk through the exact process I'd use with a client, estimating tax brackets, planning gap year conversions, and weighing trade-offs. Hi, I'm Jordan Lehman, founder and financial planner at True Wealth Retirement Partners, and every day I'm helping my clients create steady retirement income, invest smarter, pay less in taxes, and I want to share what's working for them so that you can retire with confidence too. So let's go ahead, jump right in. So, like any financial planning scenario, the output is only as good as the input. So, go ahead, pause the video, take a peek at some of the assumptions here. I don't want to take too much time on this, and I'll highlight some basic things. Assuming an 8% return on stocks, 4% return on bonds, some inflation assumptions here. They're both 62. They're already retired, and we have them moving on at age 95. For now, we're using kind of a default Social Security assumption. John gets $3,000 at 67, Mary gets $2,000 at 67, and that's their plan. They're spending about, when you factor in some healthcare, living expenses, etc., some housing costs, about $5,500 monthly, and that's obviously adjusted for inflation over time. They like to keep a $50,000 emergency fund. They own their $450,000 house free and clear. They're debt free. They're spending about $6,000 per person on marketplace healthcare plan premiums prior to being on Medicare at 65. We assume there's 1 year of kind of an average long-term care expense in the final year of their plan, and we're assuming any excess RMDs would be spent. So with that, let's jump in. So one other thing to be aware of, and kind of the main point, is they have John, in this case, John and Mary. John has $1.2 million in his pre-tax 401k that he has planned to roll over shortly to an IRA. And the main question is, well, do Roth conversions in their case make sense? So where do we start with that? So the first thing I would want to understand as the advisor is, okay, can we estimate a bit of a baseline total retirement tax bill? And from there, we can assess the conversions for the pros and cons relative to their plan. So to do that, I would start with, okay, well, first, what in the world does their income plan actually look like? And we see here, this is them at 62. They're needing to withdraw over the next, call it 5 years, from their investments, from the 401k that they moved to an IRA, until, in this case, Social Security kicks in for both of them. And we see that actually covering a majority of their income need until what happens? At 75, RMD kicks in. So we'll take age 70 as an example. $73,104 from Social Security, and a modest, just under $5,000 withdrawal from their IRA to cover the remainder of their expenses. But again, at 75, we see Social Security inflating over time, obviously, but then RMDs kick in. It's not like they suddenly need this much more income. It's just they're required now to pull money from the IRA to satisfy the RMDs. And we see those continue over time. Why is there a big spike in the final year? Well, each of them, remember, has that long-term care expense that they need to cover, adjusted for inflation. So with that as a baseline, where do we go from here? So now we want to take a look, again, spending about $5,500 a month. We see how there's withdrawals, Social Security, RMDs kicking in. Well, what's the effective tax rate of their plan over time? We see in these early few years, frankly, a low effective tax rate, but then it turns to zero from 67 all the way to 74. Why? Because remember, that's when they're pulling Social Security in this example, and the exact taxability of Social Security, it's a topic for another time. But remember, not all of it is necessarily taxable depending on your total income. the provisional income calculation, standard deduction, forget that. Just get for now, there's a modest tax rate. And then once Social Security hit, there's no tax rates until, or no tax amount until 75, when RMDs kick in and we jump back up and steadily increase over time. Here's the key concept for John and Mary in this example. This is what I would call a tax gap or gap years. An opportunity to potentially look at, and we'll see what does or doesn't make sense, conversions, pulling income forward. There's a space here where they could potentially take some income at lower rates than other times in their plan. That they pay no tax may seem exciting, but not if it comes at the cost of paying more tax over time. So let's keep looking at this. So this is another look at a similar concept here for them. The blue or purplish here is their total taxable income. The teal bar here is the 10% tax bracket. So we see at 62, their adjusted taxable income baseline in the blue is just over 42,000. Again, this is after the deductions that they're able to take, where the 10% bracket is 23,850, the 12% 96,950. Okay, so we see they hover between the 10 and 12, and then they drop off. And then they spike back up with RMDs, and we see them actually around age 89, 88 or 89, they're eclipsing the 12% tax bracket. This is another piece we want to be sensitive of. This is looking at their Medicare premiums over time. Remember, if you have certain taxable incomes exceeding thresholds, you'll pay more for the same Medicare coverage in the future. It's the income-related monthly adjustment amount, or IRMA. So we see this is a baseline here. They never cross the first threshold. This teal threshold is an additional, again, estimated $88 a month once they're 65, based on their income from 2 years prior. Now, we see, though, right at the end, there's a bit of a spike when they're having to pay for the long-term care premiums as far as their total taxable income relative to those IRMA thresholds. So in their case, there's not a ton of income here. IRMA's not necessarily a big issue, but it's another thing we want to be aware of and thinking about relative to the conversions. So let's look at this. Ready? There's 3 things we can be aware of. And again, our goal is, what's a baseline if they don't do any conversions at all? Well, their tax-adjusted ending assets would be about $1.57 million. They would have paid over the life of their plan at just over $442,000 in federal income taxes. And they would have made withdrawals over that period of time of just over, or just under, I'll say, $4.2 million from their pre-tax or tax-deferred accounts. So now we can begin playing with some different options to see what the conversions end up doing for this client. So here's what I've done now. I've modeled a conversion up to the 10% ordinary income tax bracket in these gap years from 67 to about 74, like we saw. So now you see this is the taxable income picture with no conversions. We see that sharp drop off to nothing from 67 to 74, and then the spike with RMDs increasing into the future. Well, now the green, we can see we're actually intentionally pulling some conversions or taxes into those gap years from, again, 67 to 74, right up to, it's right in line, you can see, with that 10% bracket. And we see a bit of a more muted increase. Now we actually never, at the end here, cross into the projected 12% tax bracket into the future. And so the question is, well, what does that do to our overall plan and total tax bill? So if we move here, now we see, remember, the baseline was about 1.57 in ending assets. Now, because we've done those conversions and more money is compounding tax-free without needing to pull out for RMDs, we see the tax-adjusted ending assets estimated just under $2.4 million. Well, what about federal taxes? Well, we're seeing on the right here, this client now pays about $43,000 less in taxes to the IRS because they intentionally took advantage of those gap years rather than sitting on their hands and waiting for RMDs to take advantage of them down the line. And we see materially less withdrawals from the tax deferred assets. So, in this scenario, for this client, I think doing some conversions and taking advantage of those gap years shows a pretty significant benefit. Now, it's not the case for everybody. And I want to leave you with three what I call yellow flags. It doesn't mean don't consider conversions, it's just tread carefully. The first is if you're doing significant giving in retirement, conversions may have less juice. Okay, if you're planning to give a lot to charity during retirement, you need to consider this because once you hit age 70 and a half, you can donate directly from your pre tax IRA using something called a qualified charitable distribution. And that money actually never shows up as taxable income to you. It's completely tax free giving and it can satisfy your RMD. So see how if you paid the taxes to convert that to Roth and then gave from the Roth, you paid taxes unnecessarily. You could have given it directly and paid no taxes in the first place. So first yellow flag, if charitable giving is a big part of your plan, a conversion could create more taxes, not less. The second one is balancing marketplace plan premiums. It's a sneaky one that people often overlook. If you're on a marketplace health plan before Medicare kicks in, Roth conversions could actually spike your income and wreck your premium subsidies. Okay, these plans are income based, and even a modest conversion can push you over the cliff, meaning potentially thousands of more dollars in healthcare premiums. So, if you're retiring early and relying on the marketplace for coverage, timing your conversions carefully or skipping them altogether may be the smarter move. Now, it's a yellow flag because I have a client in that scenario where conversions make a world of sense. It's just be aware of that and don't find yourself unpleasantly surprised come tax time. And the third is poor health or shorter life expectancy. Let me explain. This one's tough but important. Roth conversions are a long game strategy. You're paying taxes up front for tax free growth later. But if your health isn't great or you're facing a shorter time horizon, you may not live long enough to actually reap the rewards. Worse, you could pay a big tax bill today and never fully benefit from the growth and withdrawal advantages of the Roth. And in those cases, keeping money in your traditional IRA could make more sense. So I hope this case study format was helpful. It's kind of my first go at it on the channel here, sharing the planning software, walking through some stuff. If you've got feedback on how to improve, would love to hear that. Just want to make these as helpful and practical and simple as possible as you're thinking about the right moves for you and your retirement. Of course, there's a link below. Go ahead, schedule a call with me. Happy to be a resource, get you pointed the right direction on some of these questions for you. And we will catch you in the next one. Thanks so much for watching.